That was a great place to start our week off. Hey, everybody, Keith Pitch here. Welcome to Real Estate Now, your weekly pulse of the real estate market, mortgage-wise and real estate-wise. I'm joined here with Stacy Chevalier, my co-host. Stacy, how are you doing?
I'm doing great. Good morning.
Good morning. We've got an awesome show coming up. We've got Dan Hanson. He's going to drop some nuggets of knowledge here today, so I'm super excited about that. But first, let's talk about our views from last week and our donation.
Yeah. So what was our final tally?
I didn't tell you that before we started.
No, you didn't. Normally you do.
I did make sure I had that number available, and it was 203 views from last week's show. So there we go, another $203 to our local food banks. So super exciting.
Yes, thank you guys for all your support, and we will continue to donate to our local community.
Absolutely. And before we bring Dan in, we got to check the rates like we do every week, and we like to keep everybody up to date and what it means to be knowledgeable about where mortgage rates are going. And we hit another all-time low at 3.03%. And we've been putting rates up here for the last 7 weeks, Stacy. And I wanted to contextualize this. So if we go back to 2 years ago, I just pushed that down. If we go back to 2 years ago in 2018, November at the peak, before we came down the steep slope to the 3.03%, we were at 4.98%. So if you bought a house 2 years ago and you went to refinance at 3.03%, you're saving nearly $600. We're going to leave this Mortgage Coach illustration in today's chat. So if you guys want to check out the numbers and what it really means to take advantage of today's rates, by all means, please do. We want you to be educated. We want you to be empowered to take these huge financial decisions and make them really easy. So if you have any questions, by all means, let us know. We're here for you. But it's just crazy. You said October we're going to hit 2. We're going to be in the 2s with the 30-year fixed.
I was wrong.
You still believe that?
No, I think we're going to hit it like in the next 2 weeks.
Next 2 weeks. So let's do that. Let's bring in Dan, and that'll be his first question. Dan Hanson.
Hi, everybody.
Welcome to the show.
Hey, Dan.
Before I get started, I just want to make a plug that says for today's view, everybody that watches, for every dollar that you contribute to the community, I will personally match dollar for dollar because I love community involvement. So,
thanks. We appreciate that.
Awesome. Thank you. That is really awesome. So, Dan Hanson, you are the Chief Retail Officer for loanDepot, and we've got Stacy and I have got this running bet that when is the third year going to dip into the 2s? Stacy put it out there October. I said August. What's your forecast?
Well, I'm going to go a little differently and say it's already in the 2s.
It's true.
It just depends on how you structure that with the borrower. It's there.
Yeah. Fair enough.
I saw an advertisement from UWM the other day that said we're at 2.25, and I looked it up and I found out that was true if the borrower paid 2 points. So So the reality is we're at all-time lows, and whether we're at 3 or 2.5 or 3.5 or 4 or 1.5, it's a great time to leverage a mortgage to buy a property. Probably the best time I've seen in my 36 years. So that's pretty incredible. So
before we get totally started, we're going to do a quick lightning round with you, Dan, just so that the audience kind of gets to know you.
Okay, I'm anxious about it, but let's do it.
I got to email this. I'm just going to go because Keith doesn't have the questions. But okay, where were you born?
Honolulu, Hawaii.
What are your ties to the Pacific Northwest?
I lived in Edmonds, Washington for 12 years, and I ran operations for several companies that were in the Northwest. So I'm very familiar with the Northwest, and spent my formative years in Edmonds.
That's awesome. Where did you go to college?
The University of Redlands, which is in Southern California. It's a small liberal arts school.
What was the mascot?
Bulldog, of course.
What's his name?
Well, we've had 5.
Oh,
No, it was the mascot's bulldog name.
Yeah. Oh, the mascot there, Uga. It wasn't Uga. That was Georgia. I can't remember.
That's Georgia.
They've had
Keith
so many
knows
since
it.
I've been there, right? They've
It's
had
Deacon.
Yeah, it could be.
Deacon.
Yeah,
It is. We looked it up.
You looked it
Yeah.
up.
And by
How
the
many
way,
bulldog?
surprisingly, a lot of folks from Seattle go to school in Redlands. It's like
Oh.
interesting. There's a pretty strong contingent of Washingtonians that are in that go to the University of Redlands. I'm on the board of trustees there. I'm still pretty active, so it's a great school.
Oh, nice.
How many bulldogs do you have currently?
We have one. We had 4 English bulldogs, and then we finally caved in and got a French bulldog.
Oh,
Primarily because I couldn't lift the English bulldogs anymore. And her name is Kona, and she is a doll and a little more active. You know, English bulldogs have a lot of couch time.
yes, they do. I had one for 12 years, so I'm a bulldog lover.
They're so sweet. It's unbelievable. But Kona's a little more active, and she's running us around a little bit more, but she's fun.
Okay, a couple more. Pre-COVID, what was your third spot?
My third spot has always been, it used to be the woods when I was in Washington, believe it or not. I used to, back in those days, you know how parents were. They said, go away, come back when it's dark. And I would just go in the woods and fantasize about forts and Swiss Family Robinson and everything else I could think of. But today it's the beach. I live in Newport Beach, and I've become a devotee of just enjoying the beautiful ocean.
Oh, that's awesome. So for our audience that might not know, the third spot is you have 3 main spots you go to, right? Your house, your work,
Yep.
and then your third spot.
Yep.
3 words to describe the team in the Pacific Northwest.
Well, since I'm on there,
Or more.
I should use the good words. Actually, the Pacific Northwest is a special group. They really started from scratch. We didn't have a big brand in the Northwest, and not many people knew loanDepot. And I remember when I opened the first office there, we basically had no employees, and we just started out. And Stacy, of course, you were there. I got a chance to meet you and convince you to leave a very secure and great job with a home builder to come into the wacky world of mortgage. And it has grown to be one of the biggest and largest and most productive offices in the country. So we're very excited about the Northwest. It's actually a tremendous market for mortgage bankers, and it has a lot of smaller communities that kind of really need outreach from the mortgage banking community, because banks aren't in a lot of those communities. And it's such a diverse, people don't realize how diverse it is. I mean, you've got, the ocean, to the left or right of you, depending on where you're standing. And you got Spokane, which is way out there in snowland. It's an amazingly diverse. Eastern and Western Washington are so different. And now the Puget Sound and the rest of the world is very different. You guys have become mini California up there.
True.
Pricing is huge. The traffic is difficult. The politics have leaned a little more left than right. Mm-hmm. And you have great tech. So I kind of look at it like a little piece of Silicon Valley's kind of transported up there to Seattle.
Just a little bit more rain.
Yeah, just a little bit more rain.
Yes.
Yes.
A little bit more rain.
It's okay. It's still beautiful. Okay, last one. How did you get into mortgage? What was your start like?
That was interesting. I was actually in the title business for 8 years. And I really enjoyed the title business. I was running an organization called Safeco Title back in those days, which were, when you guys were not born yet. And it was really fun because the title business then was so connected to everything. You were out and around. You knew everyone in town. It was very interesting business. So anyway, long story short, my title company Safeco, which by the way, Safeco Insurance was the owner in Seattle. They sold the title company to a competitor. And I did not like the competitor, as I don't like a lot of competitors. And that's
interesting. One of my first interviews ever out of college was for Safeco in the big Safeco building in Seattle. And they didn't hire me. And so I went to law school.
Yeah, well, there you go. And now that they've sold to Liberty Mutual. So Safeco sold to Chicago Title. I did not want to work for Chicago Title, and I didn't know what I was going to do. And a friend of mine, a very good friend of mine that was running a mortgage business, a really small little mortgage company out in Riverside, California, said, "Why don't you come to work for me?" And I go, "Well, I don't know anything about mortgage at all." And he said, "Well, we do. We know a lot about it." And he said, "You know, every builder and realtor in the Inland Empire, where I've been a title person for a long time." He said, "So just bring those relationships over and we'll teach you the mortgage business and we'll get along great." And he just brought me over, sat me down in front of an underwriter and said, "Teach this moron how to do a loan." And
do you remember what rates were at during that time?
Let's see, that would have been 1985. So they were probably like back in those days, mortgage bankers didn't do conventional loans. We only did FHA and VA. And those rates were set back in those days by the agencies. So everybody theoretically had the same rate, right? Even though they charged different rates all over the place like we do today. So we only did conventional. We didn't do conventional. That was for the banks. And of course, jumbo was like not even thought about for mortgage bankers back in those days. That was all the bankers. So we just concentrated on FHA, VA and served first-time home buyers, a lot of rural community lending, down payment assistance. You learned a lot about how people live their lives. It was my first loan was to a Hispanic family, and they had a house with literally concrete floor. And it was about 400 or 500 square foot house, very small house. And they were so proud of this house that they invited me as their banker. Because in the Hispanic community, bankers had a lot of reverence back in those days. I don't know if they still do, but they did then. And they invited their banker over for their first dinner in their new house. Oh. And that hooked me on the mortgage business.
Yeah.
Because they just were so proud of their little 650 square foot house. And they had a lawn out in front. The guy trimmed for me before dinner, and they cooked up this great dinner. And they were so thankful that I helped them get the credit that they needed to buy this house. And they had such pride in being Americans and being in this house. And they were second generation Hispanics. It was, from then on, I said, "This is it. I've never felt so good about myself as I did when I left that dinner." So that kind of hooked me.
That's powerful. That's super powerful. Wow.
They were fun. They were great. And I saw them for years after that still.
Nice.
Okay, that's the end. I can go on forever, but we'll end the lightning round there and head into what's going on in today's world.
Okay. Well, as everybody on this call knows, the world and specifically the United States is going through this tremendous pandemic, which is causing so many ripple effects, it's hard to imagine. So I'm not going to bore you with all that, but I am going to make one statement that's really important that I think we all have to take for granted. We're probably in the greatest interest rate opportunity for mortgage banking that we've seen in our history. More equity in housing than we've ever seen, more refinance business than we've ever seen. You can't do it if you're in the hospital on a ventilator. It's very difficult. So you have to be safe. You have to take care of yourself. You have to be smart. And your loved ones have to be smart. It's so weird because you literally have people that you trust that are taking care of themselves and you want to hang out with, and ones that you're kind of concerned about. It's actually doing some very difficult things in our society. But as mortgage bankers, we're not first responders. I don't want to get too crazy here. But we are a significant part of the recovery of the country, and helping people get their interest rates as low as possible, reducing their costs and debts during this time of crisis is very important. So we got to be smart. If you're not wearing a mask, I know I don't like masks either, wear one. If you're in places where you need it, wear one. You just, if you miss this because you're sick, first of all, it's terrible to be sick, and you take the risk of permanent damage to yourself. But we have an opportunity to serve so many people if we're healthy and active. So I'm in California, so we're having lots of fun down here. You've had your share in Seattle.
Yeah. But early on, loanDepot took the stance to protect their employees over everything, and we've been home since since March, I think.
March, yeah.
Right, and I actually talked to Anthony last week, and he is at no interest in hurrying back to offices. He saw very early on that this is probably going to be a longer process, especially with the American culture and the way in which we live our lives. We're just not, very, we don't follow orders real well. That's what my wife tells me constantly. But I think that he's not interested in sending everybody back to the offices, and we're very fortunate to have the kind of technology that enables us to do our business. I mean, we moved 6,500 employees in a 7-day period all home. And then and have consistently recorded record months for 5 months in a row. So
what's so fascinating is we didn't skip a beat, right? During that transition, we still just kept working all the time, and other companies that we depended on, like they had to shut down for a couple of weeks when they moved their employees.
And then we had to go through this incredibly, and I should talk about it just briefly, that the government is a wonderful thing. They're there to help us when we have tremendous problems like this. But sometimes when they pass political bills, like the CARES Act, they want to make very big political statements that appear to be helpful, like the PPP program, like forbearance. But they don't give great detail. They just throw it out there. And the complexities of forbearance, for example, is something that's really causing problems for people today. They didn't realize that, when you accept this gift, you put yourself in a box that you may not be able to take advantage of interest rates. And we still, to this day, have not gotten any guidance from FHA on how you get out of the forbearance penalty box. I mean, we've been asking, and they haven't been telling us. By the way, sneak preview for those of you on the call today. We will be putting out VA guidelines on forbearance today or tomorrow.
Wow.
So it'll be out in the industry, I'm sure. It's similarly, because VA is making the announcement generally. They're kind of following some of the guidelines that the GSEs had set out, which basically said, if you took forbearance, you have to have a certain amount of payments on the old amount for a period of time before you're out of the penalty box. But a lot of people didn't realize that they couldn't take advantage of these low rates if they had accepted forbearance.
Yep.
And the other part of it was the PPP program. There was a list put out today, kind of a blacklist by David Stevens, that shows hundreds of mortgage companies that got large amounts of PPP money. Yeah. And he's going, give it back. The federal government lowered rates. You're doing really well. You don't need the PPP money. In fact, you're hiring people. You're not, you're growing. So the only reason PPP existed was to maintain people on payroll while you were going through this crisis. It didn't cover rent. It didn't cover operating expenses. It covered salaries of people. So if the mortgage industry is benefited by low rates, should they really get PPP money? Should we give that back to the government and let them give it to people who really need it in their business model? Interesting question. And I'm not here to make judgments about that because I'm not the former president of the NBA, but it's an interesting question. And I think business owners need to think very seriously about whether that money from the government was needed by them or not. And if not, give it back.
It's a good point.
So anyway, COVID is a challenge.
Good point.
And we're all working very hard, and I think we're going to see, an extended period of time for this. It probably, by state, they're all different. But clearly, we're trying to reopen parts of the economy as quickly as we can and get people back to work. It's very difficult for people working at home with children, and homeschooling is, I watch my grandkids go through that, and it's like, wow, hard work. And now they're still concerned whether they're going to open schools and how they're going to open schools. And there's just a lot of uncertainties about the epidemic.
Yeah, that's the $20 million question right there is, are they going to reopen schools and what's going to look like? So we'll see how that all plays out.
You don't need to answer this, Dan, but we would like a loanDepot teacher, please.
Yeah.
So that request will be passing your desk.
Yeah, there's very few people that want me teaching their children.
Not you. We just want we just want maybe
we need the budget for a teacher.
We have a pretty big team. Yeah. We need some north and a south sound teacher, I think.
Yeah, it's a really a big thing, and while they're working at the same time simultaneously in the same office, so it's very difficult.
Yep.
So talk to us a little bit about the complexity of working from home, volume for the retail loan officers way up. How are they supposed to manage in a time like this, Dan?
Well, look, if you've been in the industry as long as I have, you've seen a lot of these kinds of markets. Maybe not quite as extreme as this market, but we've had significant refinance markets in the past, and we've had rates at 18%. I bought my first house at 17% interest rate.
Wow.
Very smart timing on my part. But the reality is, there are two types of loans when you boil everything down. I know our business is complex and there's thousands of products. There's only two types of loans. There's a refinance and there's a purchase. And so in this environment, I started looking at those two different things, and I thought I'd walk through 4 or 5 things that originators could think about when they're looking at refinancing and managing that business, as well as the purchase side of the business, which is, by the way, we're seeing some of the largest purchase months applications we've ever seen.
Huge right now.
There's a huge pent-up demand because the inventory is tight, which I'll comment on in just a minute. So let's talk about refinance because it's pretty easy. If you've got a large book of business, if you've been in the business now for 4, 5, 6, 7 years, and you've got 500 people in your database that you've given that trusted you to do their mortgage the first time, I want every originator to know that's your number one priority. The people that gave you the opportunity to do their loan first need to get your attention first. Meaning, you need to talk to them about what forbearance means. You need to talk to them about where interest rates are. You need to understand their financial position and not just give them a rate and term refinance when they really have high short-term debt that could be folded in to low long-term debt, right?
Yeah.
And a lot of our originators are running out getting new borrowers, which is great, but the borrowers that you have in your CRM, that you are working with, that that have given you their mortgage over the past few years, you really have an obligation to reach out to them and make sure they understand in this COVID environment specifically what their options are. And I will mention one thing that we overlook. We joked at the beginning that we're already in the twos. If you're a loan originator and you sit down with a borrower and they say, what's your rate? Because it's more of a transactional situation. My current rate's 3.75. What's your rate? Right? I mean, that's the common question.
Yep.
And I kind of go, well, what rate would you like? Because I have a whole bunch of them. From 2.25 to 3.25, I got all those. And they go, you're kidding. I go, no, they're all here. They all have a cost, right?
Mm-hmm.
So this one has no cost. By the way, there is no such thing as no cost loan. We all know that, right? We have a finance cost loan. And then we have points.
Good point.
Yeah.
Yeah.
And in
I don't know that if the general public is out there watching, really understand that. So just in a couple sentences, explain it.
Well, when people put out marketing materials that say it's a no-cost loan, what that really means is you don't have to come out of pocket with any money today to make this loan happen. Because we're taking all the costs that you would have paid out of pocket right now, and we rolled it into a little higher interest rate. So you're going to pay it over the time of your loan. Which means if let's say the closing costs were $2,500 and you would give me that in cash today, and I'd give you this rate, instead of that, I'm going to add an eighth or a quarter or whatever I need to that rate to cover that. And then you're going to pay for that for as long as you have that mortgage, which means you might end up paying $6,000 for that $2,500 you didn't pay up front if you keep the mortgage for 2 years, 3 years, 4 years, right?
Yeah.
So there is no cost mortgage. When you see that, you immediately go, wait a minute. Not true. There is no free lunch. There is no free cost. There's a cost to originate a loan, and it's baked into the interest rate. And then there's points. And it's fascinating. On the west coast of the country, because I've done operations on both sides of the coast, they rarely pay points on a refinance. It's the no-no loan all over the place, right? The East Coast, they pay almost 50% of their refinances have a points cost.
Whoa.
And why is that? Well, because loan officers have explained to them things like the following. Everybody's familiar with the famous pricing exception. I need a pricing exception. The borrower wants a lower rate. They run into Stacy, they run into Trevor, or they run into who their manager is and go, I need, X amount of participation from our branch, not on my commission, by the way, but on the participation from the branch to help the borrower, right? So when I was a loan officer and I was doing a refinance back in those days, and I was learning from the guys on the East Coast, what they would say is they'd say, look, for a point, you can get this interest rate. And the borrower would go, wow, a point. Now, back in those days, mortgages were a little less expensive, right? Now they're $500,000 to buy a starter home in Seattle.
Yeah.
But so $5,000. If you give me $5,000, you get 2.75. Or I can give you 3.25 for no cost at all. And then you kind of go, how long are you going to be in the house, right? And the best PE in the world is when you go as a loan officer, if you have to do that, and say, look, if you put up a 0.5 point, I'll match it with a pricing exception from my company. So now you've got your point. That's a great PE because, first of all, the borrower's in. The borrower's giving you some money.
Yeah.
You're not going to have that borrower shopping you at the last minute and losing a borrower. They're engaged. You've explained to them how many months it's going to be to pay off that amount of money at the lower interest rate, right? The difference between the rate you would give them without the point and the rate you would give them when they put up a 0.5 point, there might be a 6-month payoff on that loan. That's nothing. If they're going to stay in the house 5 years, you just saved them a bunch of money, right? So refinance is not just about what's your rate. Refinance is understanding what the borrower's circumstances are, how long they're going to be in the home, explaining points to them, explaining how mortgage interest rates work, how costs work, so that they can really have a good understanding of the process. I mean, it's like a doctor counseling you on a particular procedure. You want to get all the facts before they knock you out and start cutting things off you. So,
well, and that's where, as advisors, we have to take it to the next level, because the consumer public has been conditioned, so to speak, to ask that one question, and that's what they boil the whole decision down to. Right. And we can't be afraid to ask those questions. How long are you going to be in the house? That's the first question I always ask people that say, hey, I want to do a refinance.
Right.
Great. How long are you going to be there?
Say, look, you guys, are you in the twos? I go, yeah, my 15-year mortgage is in the twos.
Yep.
So are you going to live in? Are you going to pay your house off? Is that your objective? If it is, I can actually give you a lower payment than you're making now, and your house will be paid off in 15 years instead of 23. 7 years of interest, right?
Yeah.
And the guy goes, "What are you talking about?" And I go, "Let's do the math, right? Let's look at the situation." That's a great count, and the guy may choose the 30-year fix. That's fine. It's okay. But if they're disciplined and they want to pay their house off, 15 years is a great product. Nothing wrong with it. And if their payment's actually the same or lower than it is now, and their house is going to be paid off 7 years sooner, that's a win if that's what they want. So in refinance business, our objective now is to do as much refinance business as we possibly can and not lose focus on the second part of the equation, which is our purchase business. So I'm going to talk about that for a few minutes, because purchase business is, in my opinion, the only way to measure the success of a loan originator is how much purchase business you do over your career. Because refinances are really, tides raise all boats, right? Purchase business is the hard work of building referral partner relationships. It's the hard work about educating, incubating, helping borrowers understand the process that have never done it before. And it's also about lead management. We're one of the, loanDepot happens to be one of the companies that provide tremendous amounts of leads to their originators. Other companies do too, by the way, obviously. But we provide more than any other company to their retail franchise. And this month, we're actually going to do over 12,000 leads.
Wow.
If you figure we have, let's say, 1,900 originators, we're going to put 12,000 leads out. And they have a whole different types of leads. We have purchase leads, we have refinance leads, we have trigger credit leads. Believe it or not, if I'm a loan officer and I get a credit trigger that says a borrower in my portfolio has just had their credit pulled by a mortgage company other than myself, I should be ashamed. Because I should have proactively been reaching out to that person way before they decided to pull a credit report from somebody else, right?
Amen.
So
Yep.
we have an amazing statistic that makes me crazy, which is we have loan officers who get credit triggers and never contact that borrower for I don't know reasons that are like beyond me. It's like I don't understand. We put out in the money leads, which says in our portfolio the following 10,000 borrowers have an interest rate that's over 4, and we have loan officers that won't call them. Wow, over 4? It was a great ad. I love this loan officer ad. It was I think it might have been in Facebook. I'm not sure. It just said it had Jeff Foxworthy. I don't know if you remember the comedian who does all the you might be a redneck, right? Kind of joke. Got his face on there and it says, if your mortgage starts with a 4, you might be a, and then ... It was very cute because we have an obligation to get to those folks and help them. So lead management is a skill that loan officers typically is a muscle we're weak at. We don't know how we know how to take care of a borrower that's got a transaction going. We understand how to pre-qualify a borrower that's looking to buy a home. We those two things we got those muscles. Those are really strong, right? The weak muscles are the guy who kind of comes in and goes, I'd like to understand the process. I've just been fooling around on Zillow looking at neighborhoods, but I really don't know anything about the mortgage thing. I don't know what I could qualify for. I'm really not ready to buy a home yet, but I'm just starting the process. Loan officers often respond there like, well, call me back when you're ready to go.
Right.
That's a bad response.
True.
Now we're able to buy Zillow leads, purchase Zillow leads. Originators can buy them themselves at loanDepot's discount. That's a huge advantage for you all. And you can use our FEC and get the tax benefits for that as well. And then incubate them with your realtors. Guess what realtors do every day? They incubate.
Yep.
They harass. They keep sending you, houses to buy. Their job is to find people that are not necessarily in the market, that will be in the market at some point, build a relationship, so when they are there, they will use them for their services. Help your realtors incubate borrowers if that's not your strength. And I think we can get that done. And the use of the CRM and the technology we have can do a lot of that work for you. And we talked before the call a few minutes about CRM and using tech to help you manage your customer relationships. Not just by sending them banana cake recipes, but sending them a forbearance, bullet point saying, hey, if you're in forbearance or thinking about forbearance, give me a call. And you're not trying to discourage them, but you want them to know all the facts about it. That's all. I had a person call me the other day and he goes, I applied for forbearance, but I never took it and I made all my payments. Am I still able to refinance? I said, yes. Just because you applied for forbearance doesn't mean you took it.
Right.
You were accepted for forbearance, but you kept making your payments. You are not in the penalty box. So anyway, I think that the purchase side of the business now in a tight inventory means you have to know things like what's a 203K? Yep. Why? Because how do you build inventory? Well, you take a 2-bedroom and make it a 3-bedroom. That just built the inventory, right? You're not a home builder, but you built the inventory. And by the way, the cheapest construction loan in the world is a mortgage at 3%.
Yep.
Go for it. You can't get that at the bank, believe me. So you got to know the 203K. You got to know home builders. Why? Because home builders are building inventory every day where resale markets are very tight. Sellers, many of them are holding back their property because of COVID. They don't want to put their property on the market right now. They want people walking through their house, blah, blah, blah. Or they're concerned about their financial sustainability, right? And so they're kind of hesitant to make these changes. So resale inventories in most markets is very tight. So the only new inventory that's being built is home builders. Yeah. So if you've never gone and called on a home builder, even one that has their own mortgage company, you should take our certification class, grab a hold of Rick Fletcher or Stacy or a lot of other folks that know what they're doing and talk to home builders. There's a ton of them in Washington that are not giants. They're small. They do 15, 20 houses a year. Those are great clients. You should also talk to investors. Investors are still buying property. And if you get an investor who buys 3 properties a year and that's a client that you work with, you not only build a relationship with the investor, but the person that they sold the property to. You have another opportunity to build a connection and to make sure you have a relationship forever. So we can't get sick. We got to take a lot of amphetamines. We've got to make sure we stay awake and aggressive because we've got this great opportunity, and we have to keep our family from going insane. So we got a lot on our plate, a lot of spinning plates, but we are blessed. We are lucky to be in this industry, and we need to take this opportunity to take all of our skills, have very clean motives, and help borrowers achieve what they're trying to achieve. That's what success is in this business. And you get remembered and you get referred, and your life is immensely improved because you're a real professional when you're doing it in that way. And I know that's something you guys preach in the Northwest. You got some of the best people ever. Unfortunately, we're sending all the California people up there, so your culture is going to get all wrecked up now. But hey, you're going to have to turn us. You're going to have to help us, be better Washingtonians and help one another. And we'll try to help you how to figure out how to navigate that traffic, which the 405 and 5 are just looking real similar to the ones we have down here in California.
Yeah, they are, day by day.
But I'm thrilled that you guys are out talking to people. Everybody who's on the call, it's great that you're here. We're going to make a contribution on your behalf, and I'm going to double it apparently, but my wife can afford it. And
appreciate it.
Yeah, I'm saving lots of money not shopping right now, except for boxes are showing up a great deal at the Hanson residence. But we are in a great opportunity to go after it. We have to be smart, knowledgeable, work hard. And if you're a big producer and you've done you're doing 8 to 10 loans a month, and you've done that consistently for a while, you need to think about getting a team together. You need to think about talking with your manager about getting someone to help you manage the amount of referrals you're now generating because you've gotten to a certain size. And I think that's what a lot of top originators have done and are doing. It's kind of a phenomenon in our business. So have realtors. If you notice, realtors that have top realtors, they're no longer just a realtor. They're a brand of a team because they have more referrals than they can handle. Just be cautious, guys. Don't take on expense during a refinance boom that's going to have to be taken away when the refinance boom isn't here.
Right.
I mean, if it's a short-term job, it's a short-term job. Maybe you bring in somebody as a temp, because the reality is, yes, it's going to be sustained low interest rates for a long time. And this employment thing and the effect of COVID is going to impact the mortgage industry down the road in the ability of people to refinance and the ability to purchase homes, ultimately. We have a lot of millennials that want to buy houses now. And Trevor, I know, has used that famous partnership mortgage we've talked about for a long time, which is the fact that people that are not related can buy houses together. That may be what you have to do to live in a place like Bellevue. It's super expensive. And if you don't want to drive an hour to work, maybe you and maybe 2 nurses can buy a home together. They have shifts that are at the same hospital, or they may have different shifts. They never even see each other, but they don't have to drive an hour and a half one way and then be exhausted at work all day.
Yeah, no, it's a great product. We've seen, every story is different in that product. So
Really. And we have cops who, believe it or not, live in Idaho, and they're cops in Newport Beach.
What?
Yeah. It's
wow.
bizarre. And we have firemen that work outside the state because they have, they're on 4 days, off 3 days, and they can sleep at the fire station. Well, they can also buy a condominium together and they can share it. So we've seen a lot of these kinds of stories. I think lending is going to evolve just like our culture is evolving. Our culture is very different. When I grew up, sharing a house with someone that wasn't related to me was like really foreign.
Very
like
foreign.
who's going to hold the clicker? That's really critical. Now millennials don't have clickers. They have computers and their own headsets, right? It's not a problem.
Right.
There would have been a freaking war zone around the TV when I grew up. So anyway, I'm excited that you guys are doing this. I think it's a great thing. And I think it's really great that you're contributing back to your community. We really need to do that as an industry that's flourishing in this traumatic time. I think we have an obligation to do everything we possibly can to help those that are struggling through this. And it's very good that you're doing that. And that's why I'm more than happy for the 5 people that are on this call. I'll send my $5 up to you. and it will be great.
There'll be more. It's over the week. It's over the week, Dan.
That's all right. I'm in. I'm in for the whole bucket. You just let me know. I'm
Beautiful.
gonna do it. I'll
We appreciate it.
I'll of course have to verify.
Yes.
Other than that,
Right. Yes.
in fact, I'd like an underwriter to actually call me with the number, if you don't mind. I'd really appreciate it. A sales guy, they always kind of blow it up. You know, they exaggerate.
We haven't gone
There's
viral
no puffery
yet, but
going on. No puffery.
yeah.
Well, I for all those on the call, whether you're in the real estate industry and a great partner for all of us, and for the consumer you're trying to help, or loan officers with other organizations, or clearly our own loan officers, I wish you the very best. We're in a great opportunity to succeed and to help people, which is tremendous. I mean, our reputation has not always been stellar. We've had a few years when it wasn't. And we have a chance now to really redeem that in the eyes of the consumer and the eyes of our industry. So I hope you all do that.
Day in, day out. Well, thank you, Dan.
You're welcome.
Until
You
next
guys.
time.
It's nice to see you. I miss you guys down there.
I do too. I'm really, August is usually my month to come to Seattle. It's a nice month to come up there.
Yeah.
So wear a mask and maybe I can come up there in a month or two.
Maybe. Right on.
Stay away from
We'll
those
catch you
bars.
later.
All right. Take care, you guys.
Take care.
Thank you. Right on. Well, that concludes our show here this week. And Stacy, look forward to tuning in next week for another great show.
All right. Sounds good. Thanks, Keith. Have a good day.
Take care.
Bye.